Silver investors could make a fortune. Billionaire Eric Sprott and other top gold analysts predict that silver will dramatically outperform the yellow metal. In order to maximize your exposure to silver, consider shares of Golden Arrow Resources trading on the TSX Venture under GRG and the US as GARWF, where insiders have accumulated 50% of the company, and billion-dollar giant Silver Standard Resources has taken an 8% stake in the company. This company has 250 million ounces of silver resources and is headed up by the one man who is responsible for the largest silver deposit discovery in history. Learn more at crushthestreet.com/silver100.
Hello, everyone, and welcome in to crushthestreet.com. I am Kenneth Amaduri, and I wanted to have a guest on who we could talk about precious metals, the stock market, and what we are seeing here with the junior mining companies, the stocks, this bull market that has started, and we're kind of just in the tip of the iceberg here of what we are going to see. I mean, historically, you look at some of the charts, the GDX, the GDXJ, sure, it looks like we've come off big off the bottoms, but, going back a few years, we're still a long way from the tops. So no better person to talk about that all with than Jordan Roy Byrne. He's with TheDailyGold.com, and he's the author of The Coming Renewal of Gold Secular Bull Market. And of course, this is available for free at his site at TheDailyGold.com. Jordan, thanks for joining me.
Kenneth, it's a real pleasure. Thanks for having me on.
Absolutely. Jordan, in a world of currency wars with the U.S. dollar actually strengthening, it would appear that gold would initially fall in this environment. And, looking what happened this week after the Fed came out with their hawkish statements, the yuan got devalued by a lot. And the dollar strengthened, and gold and stocks both fell alike. And in a world where the Fed is trying to tighten monetary policy, is there room for gold to run higher?
That's a very good question. I think it depends on a number of factors. Where we are right now with respect to precious metals and the miners specifically, the miners have had a very, very strong move, and they've been overbought for a while. And now, when you're coming out of a bear market, something will be overbought for a long time. So that's actually, in the general picture, that's a good sign. But again, the miners have been overbought for weeks. They haven't had more than 11% correction. I haven't checked in the last day or so. They may have exceeded that. So the miners basically, they're ripe for a correction. A couple other reasons I'm looking for that. Number one, if you look at from about 2000 to 2015, or just look at the last 15, 16, 17 years, the month of May tends to be a turning point. And for the most part, when miners are in a bull market, they often peak in May. So the seasonality right now is bearish. We know that the miners are ripe for a correction. And then the other thing is I have these analogs, so I track how the mining stocks are moving compared to how they moved off the other two major lows, the one in late 2000 and the one in October 2008. And basically at this point in time, the miners in both of those other bull markets, they had a 20% correction. So they're very ripe to have a correction here. I think they probably will correct more, even though they're having a decent bounce today. And that could, just in the short term or in the next month or two, that could coincide with some dollar strength because the dollar was kind of oversold. But some people are talking about the potential for gold and the dollar to go up together. And I think that's possible. For me, it really depends on negative real rates. If we see the dollar moving higher because real rates are going to strengthen, that would be bad for gold. But if real rates remain negative and they're even getting more negative and the dollar is going up, you could see gold go up at the same time because that's the fundamental driver of gold, falling real interest rates or negative real interest rates. So that's something to keep in mind. And then also working in the stock market, which I think you briefly mentioned, looking at the stock market, if we see the dollar go up and the stock market go up, then I don't think we would see gold rally during that time. But if the dollar is going up and the stock market is going down, I think that's bullish for precious metals, just because if the market goes down, then the policymakers would worry about policy being too tight. And looking at the stock market where it is right now, I mean, I think the last time we were on was a couple of months ago, and I'm not as keen on the stock market as I am with precious metals, but I felt that the stock market, I mean, it was very oversold in February, so it was ripe for a rally. It probably rallied a little bit more and was stronger than I expected, but it looks like the market peaked here at the end of May, and it's very interesting because if you look at just the last couple bear markets, and including 2011, 2011 May was a peak for the market. I think it had a severe correction. I don't think it was 20%, but it was close to that. And if you go back to 2008, the market, of course, fell in January. Then it rallied into, I believe, May, and then that's really when the big move came down was after May. I mean, I like to look at the NYSE index because that's bigger and broader than the S&P. And in 2008, the market rallied up to its 80-week moving average and failed and turned down. The same thing happened, I believe, in 2001 and 2002, and where I think it was May. In 2001 it was May, and then the market made a lower high in May, failed at the 80-week moving average, then had a pretty big sell-off. The same thing happened the next year in 2002, although the market peaked in March. Then it had a little bit of a rally into May, and even from there, it had a hard fall. And so if you look at the NYSE, where we are here and now, I mean, in recent weeks, the market rallied up to the 80-week moving average, failed, and it's turning down. So, and it's making a lower high. I mean, the biggest declines have come in 2008, 2001, and 2002, and that's because the market was making a lower high when it had that secondary peak in May. So now the one thing I'd add is breadth for the stock market is a lot stronger than it was in 2008. So I don't think we're going to see like a crash move down in the months ahead, but a lot of things are lining up for the stock market to basically sell off in the weeks and months to come. And seasonally, the market often tends to bottom in October. I mean, September tends to be a really bad month. You know, we know the whole sell in May and go away, and that really works best in bear markets. And when the market is not in a bull market, it tends to be very weak from May to September. And so I think we could be setting up for something like that. And just to get back to precious metals, I mean, if we see the stock market falling, as I think should happen in the weeks and months ahead, then you're not going to see any real tightening from the Fed. I mean, they might hike once and then turn it back, or they might just go dovish completely going forward. But I think that kind of setup, as far as the stock market falling, I mean, that would be very bullish for precious metals. Not necessarily like in the next week or the next month, but just looking, 2, 3, 4 months into the future. A falling stock market would be another bullish catalyst for precious metals.
Mm. Yeah, it really does seem like the perfect storm of events. And something that you actually pointed out in your content that you produce is that we have experienced the worst bear market for precious metals, the mining sector, in 90 years in terms of price. And I got to ask you, what happens during a new bull market for the precious metals sector following a horrible bear market? And is what we're seeing today consolidation here for the miners, and is it still bullish for the long term?
Well, with respect to consolidation, that has to do with the macro fundamentals of the gold mining space, where if you go back, and there's other analysts who talk about this, and this is more of their area of expertise, not mine, but if you just look at what's happened in the last 20 years, basically, we had this huge move higher in metals prices, so a lot of money went into the ground, went into drilling, went into trying to explore and find new deposits, and we didn't find anything, to be honest. I mean, we haven't been finding and developing enough new deposits to keep pace with production, and that isn't, I mean, that doesn't really put the industry in a problem situation in the next couple of years. But if you're looking 5 years out to 10 years out, and you look at the pipelines of the major gold mining companies, they're just bare. I mean, they really have nothing, and it takes, I mean, if you were going to explore today and go out and try and find a gold deposit, turn it into a mine, I mean, it's going to take at least 10 years, maybe even 15 years, and that's if you even find something that can be economic at these metals prices. So those macro fundamentals are basically going to force a lot of consolidation in the industry, as large companies they're going to have to buy out these smaller companies. And we've already seen 3 acquisitions recently. We saw Endeavor Mining take out True Gold. Now Gold Corp acquired Kaminak last week, and the other one was Tahoe Resources. They acquired Lakeshore Gold. So I think we're going to continue to see that. And for the non-major companies in the industry, it's probably going to be, eat or be eaten. The intermediate producers or the mid-tier producers, I mean, they're going to have to buy the smaller companies, or they are going to be eaten and acquired themselves by the larger companies. And just to touch on the first part of your question, when you're coming out of a really bad bear market, the new bull market, and this is true for really any market, not just precious metals, but the new bull market tends to be really strong in the first year. I mean, the corrections tend to be very small. They tend to occur very swiftly. And you can go back and look at how much the stock market moved in 2009. Look at what tech stocks did after they crashed and bottomed in 2002. Look at what gold stocks did after the 2008 low. And you'll see that when you're when you're coming out of a really bad bear market, that when this market turns around and is in a new bull market, I mean, there's really no major significant correction in the first 9 months or year. I mean, the recovery it's like a V-shaped recovery. It just keeps going and going without any major setback. And I mean, that's just because the bear market was really bad. And look, as the bear market keeps getting worse and worse, there's fewer and fewer sellers along the way. And eventually it bottoms when all the sellers are gone. Of course, we don't know that. We can't predict when that's going to happen. But so there's basically, when the market starts turning around, there's no sellers left. I mean, the only people that bought in around the bottom, I mean, they tend to be accumulating for the long term. So when a market turns around, you have very strong hands with profits. They hold on. 0 sellers left. And so that's why the new bull market in the first 9 months to a year, it can just keep going and going and going without much of a pullback.
Mm. Well, Jordan, I got to ask you then, looking at like the COT reports here, this is a big indicator. And again, this is something that you've talked about in market direction. What are the commercials doing? What are the speculators doing? And I got to ask you, what are they looking at? What does it look like now? What does the picture look like for precious metals here, looking at the COT reports?
Well, the COT, I kind of have a contrarian, well, not a totally contrarian view of that, but I think a lot of analysts are really misreading the COT. I mean, a lot of people like to call the commercials smart money, which really isn't the case. I mean, the commercials they're the producers, the users or consumers of the commodity that's being traded. And so they basically tend to, they tend to fade the strength. I mean, if they're a gold producer, when gold goes up, they tend to sell. And then when gold goes down, they tend to buy. It's really the speculators who drive the market. And, looking at the report, one way I measure it is in terms of open interest, because we're seeing right now people are saying, oh, well, the nominal, this is the biggest spec long position ever in gold and silver. And that may be the case nominally, but if you look at that as a percentage of open interest, it's relatively high, but it's not yet at an extreme. So, I mean, you really need to measure it in open interest, because you don't, I mean, is that huge position? I mean, as a percentage of open interest in the entire market, I mean, is that relatively large like it is nominally, or is it not? And when you're looking at these, for silver also, you're looking at these net spec positions as a percentage of open interest, they're really not at an extreme. Now, certainly they're quite large. The other factor is open interest, and specifically in gold. One thing that I've noticed in the last 15 years is after gold has made a major low, open interest tends to shoot up quite a bit, and that's obviously, more people are coming in, they want to buy gold, and that happened after the 2001 low, the 2008 low, and we saw it again. There's a huge spike in open interest. So, I mean, that's a signal that the market has bottomed, and when the market has a big move higher, open interest usually tends to follow as speculators come in and they push the price higher. Now, where we are right now, I mean, we have 1,300 resistance at gold. The spec long position, I wouldn't say it's at an extreme, but it's close to that. It's fairly high, and so we could see, I mean, if the sector corrects here in June, which I think is likely to happen, gold could consolidate for a little while. There is quite a bit of spec money in gold right now that needs to come out. But looking at the chart of gold, if it consolidates and corrects for a couple months here, and then it goes back and tries to break through 1,300 in the months ahead, I mean, we have this setup where it bottomed at around 1050. 1,300 is clear resistance. So if it breaks above 1,300 in the months ahead, you have a measured target of 1,550. And remember, that's where basically gold had that big breakdown in early 2013. So those are kind of some targets I'm looking at for the second half of the year. I mean, I'd say 1,400 and then 1,550. So, I mean, as far as where we are right now in the very short term, yeah, the COT is a little concerning. But in the big picture, no, it's really not concerning.
So you talk about, these timing points, certain numbers to look out for, in the movement. I mean, looking at the technicals, but kind of going back to the fundamentals here, it really coincides with what we're seeing central banks do. Central banks are wanting to tighten, but it doesn't. I don't know, and I'll get your thoughts on this. I don't know what you think that they're going to do here going forward. Are they going to be able to tighten monetary policy, or are they going to loosen it? And is this going to be bullish for precious metals? And I know we talked about, even if they did tighten, the stocks go down and dollar gets stronger, gold goes up. But, do you think that's likely? Or do you think they're going to get loose here and start printing away?
Yeah, I mean, it's a great question, because I saw something this morning where it's just the traders betting on the Fed rate hikes. It's really been all over the place in the last couple months. So, I mean, the Fed, I mean, they're really all over the place. It's like one week, well, we're probably going to hike, and then the next week, no, we're not going to hike. We're waiting for the data, and it's just, I mean, it's all over the place. They're just going around in a circle, basically. And it just, as I said, I mean, the precious metals, they're ripe for a correction. I mean, they may have started a correction here. It probably continues into June. And, the reason for that could be, look, they're overbought, so they should correct. And people will say, oh, well, the Fed's going to hike rates. Yeah, I mean, it might be bearish at this point in time over the next month. But like I said, I don't think, I mean, if you look at the market, I think the market is only pricing in something like 1.5 rate hikes in the next year or so. So, I mean, that's really not pricing in a new hiking cycle. I mean, 1.5 hikes, it's basically nothing. That's like 0.37%. And really, I mean, if inflation picks up and continues to pick up, and the economy doesn't go into recession, then they'll probably do a few hikes and baby steps. But I don't know. I mean, it's very difficult to say. I mean, if the stock market has a lot of problems here in the next couple of weeks, then they might not hike in June. I think it's probably more likely than not that they're going to hike in June. But I think the real question is, after that, if the stock market is weak, then they could go dovish again. And I would just add, I mean, it looks like Q2 economic data is probably going to be stronger than Q1, but that typically happens. So we've kind of typically been seeing that and so what really will matter is what happens to the economy in Q3 and Q4. And if we see the market selling off here in the summer, that could be an indication that the market thinks that the economy in the second half is going to get much weaker and maybe slow further. I mean, we hear the slowing growth. I don't know how it's mathematically possible for growth to be any slower than it already is. I mean, you look at the statistics, slowest, weakest, worst recovery ever, and we just hear about the slowing growth all the time. So obviously the Fed, I think it's, again, I think if I had to guess, I think they hike once, but beyond the next month or two, I don't think it's going to be negative for precious metals. There's just no way we're going to see tight policy anytime soon. And I think what you're probably going to see happen maybe next year with the new president or the year after that, because we've seen that monetary policy is just not working anymore. And so what we really need to see is a huge increase in government spending, probably a lot of infrastructure spending that the debt or the Fed monetizes that government spending. And in addition to that, you probably could see helicopter money where the government, they give tax rebates to every citizen. I don't know. I mean, I remember, I think it was 2007 or 2008. I think under the Bush administration they did that. So I think you'll have to see the government taking a bigger role and via infrastructure spending and via tax rebates or via helicopter money, basically giving money to people directly, because the cutting interest rates, that's just not working anymore.
Yeah. Well, I couldn't agree with you more, and I no one knows for sure exactly what the Fed is going to do, but I think it's very possible to see it happen just the way you said it, maybe one and done, unable to do a whole lot here in the future. But Jordan, if people want to learn more about you, tell us a little bit more about TheDailyGold.com and maybe any new developments that you got going on there.
Well, TheDailyGold.com is my website. I post all of the free work that I do there. I usually write an article once per week. I do a video either every week or either every 2 weeks. I do quite a few interviews, so interviews like this one I post there. In addition to that, I have a free newsletter, and you can opt into that on my homepage. And by opting in, you get a free copy of my book that I wrote last year. It's over 100 pages of all the real fact-based, objective-based research that I've done on precious metals in the last couple of years. Kind of contains all my charts and a lot of historical charts and things like that. And you will also get, with that, you get kind of an updated report I did a couple of weeks ago, just kind of where we are here in the new bull cycle for precious metals. And I also have a premium service, but if you're not on my free list, go ahead and get that. And every week, every Sunday, I send out a free update with some snippets from my premium service, so you can find out a lot more about the work I do there.
Absolutely. Everyone, check out Jordan if you enjoyed the interview today and just the research that he's done. I mean, he's really been on top of the ball here, talking about what's been going on in the markets, precious metals, and just learning more about, quality mining stocks. I mean, check out Jordan's work. Jordan, thank you so much for coming on the show with me today.
Thanks for having me, Kenneth. It was a real pleasure.